to a FAR question in Ninja MCQ. Ninja MCQ for financial accounting and reporting has 1,695 multiple choice questions currently and 74 sims. And as always, it is only $47. Okay. Coal company began constructing a building for its own use in year one. During year one, coal incurred interest of $50,000 on specific construction debt and $20,000 on other borrowings. So they're building a building, and they had $50,000 of interest on their construction debt, and they had $20,000 of interest on other random borrowings. The interest computed on the weighted average amount of accumulated expenditures for the building was $40,000. So how much interest should they capitalize? Do you capitalize 50, which is the construction debt only? Do you capitalize 70, which is the construction debt plus other borrowings? Or do you capitalize 40? Now, why would they give you 40? Well, that is the weighted average amount of the accumulated expenditures for the building, which is also known as the avoidable cost. It's the amount of interest that you could have avoided if you never would have done the project in the first place. And so those are basically your options. And the rule is you take the total company interest and compare that to the total company interest expense and compare that to the avoidable interest cost, which was $40,000, and take the lesser number. So in this case, you have $70,000 of total interest versus $40,000 of your avoidable interest cost, and take the lesser number, that is $40,000, and that is your answer. Now within Ninja MCQ, we always have key relevant terms, and those terms, if you're watching the video, you can see it. If you're listening just on the podcast when you're driving around, you can't see it. The relevant terms are capitalization, capitalization of interest, and the weighted average method. Just real quickly, and if you're watching the video, you can always hit pause and read the whole thing. Capitalization is the process of recording a cost of an asset and deferring its recognition as an expense to future periods. And there's a more detailed explanation there, but that's the gist of it. Capitalization of interest is to record the cost of interest as well as other time-related costs such as taxes and insurance paid to finance a long-term construction project as an asset and defer its recognition as an expense to future periods. And the weighted average method is the average cost flow assumption used with the periodic inventory system, in which the unit cost is the average of beginning inventory and all purchases, which is the sum of the total cost of beginning inventory plus total cost of each purchase divided by the total units. And as I'm reading this, I'm like, if someone's listening to this, it's probably really hard to follow along. But if you watch the video, you can hit pause and read the whole thing. And then the book reference talks about capitalization rate. You can hit pause if you're watching the video. What's the takeaway here? If you're doing a question and you over in FAR, and a company is constructing a building for its own use, and how much of the interest should you capitalize? You take the total amount of interest for the period and compare it to the avoidable interest, and you will know that it's the avoidable interest because it's the weighted average amount of the accumulated expenditures for the building, and that's the avoidable interest cost. You take the lesser number, and hopefully that will help you on exam day.